Hey guys, in this video, I'm going to try and value Walmart and see if it's a good time to buy. If you're new to the channel, my name is Dan. This channel is all about investments. So if you're into that kind of thing, hit that subscribe button to see more videos. So we all know Walmart's business. They operate primarily in the US, as you can see from this chart here. And that hasn't really changed much over time as their revenues have grown. They do have some international presence, and you can see it's about a little bit more than 1/3 of the U.S. presence. And of course, they have Sam's Club. When you put it all together, Walmart generates about $500 billion of revenue every year. One of the first things I wanted to do is look at Walmart's balance sheet. I have to be honest, I don't like what I see a whole lot. I think their debt to assets ratio right here, or total liabilities to total assets ratio rather, is pretty healthy, 67%. It's not so bad, but they have negative working capital, which means their current assets are less than their current liabilities, and their quick ratio is dismal, which I'm not too worried about because I think they have rather fast moving inventory. I'm more focused on the current ratio, but even that is significantly below 1. So I'm not really liking what I'm seeing here, and I'm going to have to take that into account as I value the company. So here's Walmart's income statements for the past 5 years. They are a retailer. They have a fiscal year end in February. So what you have here is trailing 12 months for 2020, which includes 2 quarters from 2020 and the last 2 quarters of 2019. With that in mind, we can see a nice, steady, increasing stream of revenue. And I noticed net income is also fairly steady, a bit bumpy there in 2018, 2019, but overall pretty good. Something that's usually helpful is to divide every number by total revenue in that year. When you do that, you get a much better picture of what's going on in the company. Gross profit is usually about 25% here, 25% of the total revenue. So I'd love to see that. That's pretty good. As we move down, we notice that SG&A expenses are always about 20% of revenues. So Walmart has this consistency that I like to see. R&D is surprisingly zero. Not too surprising actually. Think about Walmart, not much innovation there. And okay, importantly, this is the profit margin when you look at net income divided by revenue. For a retailer, that's never going to be that good. So you see it is very low and it fluctuates. Most recently, it's about 2.5%. Something else we can do is break down the return on equity, or ROE, which is the most important measure of profitability for a company. We break it into its components using a DuPont analysis. So if you haven't seen my video on that, check it out. But essentially, ROE is the product of these three things: net income margin, aka profit margin, times asset turnover times the equity multiplier. With Walmart, I like what I see overall. They have a very impressive asset turnover. For every dollar of assets in place, they seem to generate between 2.3 or 2.4. So for every dollar of assets in place, they generate, for example, last year, $2.36 sales. The net income margin, or profit margin, I really wish that would go back to its previous levels there where it was getting to 3%. Let's hope they can do that. And the equity multiplier is fine. Again, that's not the best source of profitability to have, but I don't think they're over leveraged here. Here's Walmart's dividends and their stock repurchases, or buybacks, over time. They are very steady dividend payers, you can see in the orange. They have raised their dividends for a long time now. But I also like the blue line there. That means they're doing a lot of stock repurchases, which means the executives believe the company is probably undervalued. And it's another way to give money back to shareholders. So here what I'm doing is looking at the payout ratio and the modified payout ratio for Walmart. In the blue, I have the payout ratio. That's just your dividends paid out divided by the net income or profits for that year. So Walmart tends to pay about 40, 45, sometimes up to 85% of their profits out as dividends. That's great. That means they have a whole lot left over to reinvest. But what are they actually doing with that money? Well, when you look at this chart, you notice In the orange, the modified payout ratio. Now, this ratio is essentially dividends paid out plus stock buybacks, all divided by the net income. It views stock buybacks as a form of giving to shareholders as well, which they are. When you look at this, you see, wow, okay, Walmart is not necessarily reinvesting these days. They're not necessarily opening a bunch of stores. What I more see is that they are just buying, that they are paying more and more out to shareholders, if not through a dividend, then through a stock repurchase. And they're actually paying out more than they're generating in net income, which may be why we saw some unfavorable current ratio and quick ratio on their balance sheet. They're most likely using leverage to do this. Okay, so I'm looking at Walmart's statement of cash flows, and I just want to check on my hunch there. If we go down to the free cash flows from financing, we do see net borrowing was negative for 2015, 16, 17, 2018, but has reversed to become very positive there. These numbers are all in millions, by the way. So that's 12 billion. There's another 10.7 billion. They are borrowing money during the past 2 years, and they have been using that to repurchase their equity, as you can see in the line above there. They are not issuing new equity. You see all zeros for that. That's good. But they are repurchasing a lot of it. Okay, so we're ready to use the free cash flow to equity model to value Walmart stock. If you haven't seen my video on how to use this model, check it out in the description below. But just to briefly talk about it here, it's a way of valuing companies rather than the dividend discount model. And to make the model work, we need to estimate the free cash flow to equity going forward for next year, and then how much that will grow by over the next roughly 5 years. After that point, we assume some sort of stable growth rate for the company's free cash flows, and we value it like that. Now, the stable growth rate is pretty easy. I'm going to use 2.5%, just assuming that Walmart is able to grow their revenues at that point, at least at the pace of inflation or population growth and such. What's more difficult is estimating the growth rate during the 5-year period coming up, and also estimating that discount rate. So the growth period over the next 5 years, I saw on Seeking Alpha, they estimate earnings per share is going to grow at 6.08%. I'm actually not going to use a rate that high, and I'll tell you why. It's because I noticed they're borrowing more and more to buy their own shares back, and that's just not something that can continue. If you look at the free cash flow to equity formula, you need to take net income and you add to net income, money you got by issuing debt. Well, that cannot continue in perpetuity, guys. You're going to have to pay the debt back. Walmart does have a lot of debt right now. So rather than use 6.08% growth rate, I'm going to cut it down to 3%. As far as the discount rate, Walmart has an amazing business. I see no need to use an extremely high rate here. I'm going to try anywhere from 5% upward and just see how the value changes. I don't think we need to get into 10% rates. Okay, so one thing real quick here is that I actually going to use the past 3-year average of free cash flows to equity for Walmart to estimate the next period's free cash flow to equity. And then I will assume, a 3% growth rate every year after that. The reason I'm doing that is free cash flows to equity have bounced around quite a bit, and they are very impressive in this last, trailing 12 months period. But can we assume that's the new norm? I think it's pretty unlikely for the reasons I discussed earlier. So we're just going to take an average of the past 3 years, and that would be 16,380. Of course, that's in terms of millions. So that's more like $16 billion. Okay, so what I have here is a little value matrix. I've gone ahead and divided all these values by the number of shares. So you can just have a stock price per share. Free cash flow to equity growth rate. So depending on what that growth rate is, remember, analysts estimate earnings per share growth rate is going to be about 6%, but I am estimating a much lower rate. So I've plugged in anywhere from 2 to 5%. And the discount rate. So Walmart's a very low risk business, if you ask me. So I'm going to use anywhere from, let's just go ahead and say 5% all the way up to 8%. Now, if you do that, this is the fair price of the stock. So for example, If I assume Walmart can grow their free cash flows to equity at 4% a year for the next 5 years, and the discount rate is 6%, the stock would be worth about $172.94 today. Another way of interpreting that, of course, is that if you want to earn a 6% return on your investment and you assume Walmart can grow at 4%, then you need to be paying no more than $172.94 per share for that stock. So is Walmart a good buy today, being priced at just about $150 right now? Well, it depends what you want. I mean, it's a very safe company, but safe companies often deliver low returns, right? So if I assume a low discount rate, that means a lower expected return, of course. Yeah, it's a good buy. If you consider a 5% discount rate, Walmart's a good deal, even if they can only grow their free cash flows to equity at 2%. If you assume a higher discount rate, like a 7% discount rate, you want at least a 7% return. Walmart is not a good deal under any, estimated growth rate we have here. Same goes for 8%. So it's a nice safe investment, and it might be a good stock to buy right now if you consider how overvalued stocks are in general. This one seems to be one that won't fluctuate a lot. Some people just view Walmart like a bond, honestly. Walmart, Procter and Gamble, these sort of stocks. Bonds pay interest, stocks pay dividends. They're like, okay, I'll just hold on to this for a while. So they're okay with the lower returns. So here's insider trading activity for Walmart. And I noticed in the past 12 months, they have some buys, some sells, not too much difference. But in the last 3 months, there's a lot more people selling than there are buying. And that's concerning because, of course, the board of directors, the executives, these guys know more about where the company's headed than we do, in the near term especially. So let's look at the number of shares involved, and you see quickly that, the picture doesn't look good. In the past 3 months, you've had 6 million shares purchased, but about 93 million sold. That's an insane ratio, and that's pretty concerning to me. All right, so here's the conclusion. Is Walmart a good buy right now? I would have to say probably not. If you saw my video on Target, if you want a nice, safe retailer, which is kind of an oxymoron these days, right? A lot of retailers are not safe at all, but if anything, Walmart and Target are safer. I would say Target is more your pick. You can check out my video to see the numbers on that. But just looking at the insider trading data for Walmart, just that alone is pretty concerning. And when you start to get into the valuation matrix and looking at different discount rates and growth rates you assume, there's not many scenarios where you're going to be earning a good return on Walmart. So, it's one of those stocks that I doubt you're going to lose a lot of money if you invest in it. But based on the data right now, I'd say it's also very doubtful that you make a lot of money. You're probably better off just sticking that money in the stock market index in general. So those are my thoughts. It's just my opinions. If you like the video, hit the thumbs up. Thanks for watching.